Welcome to Straight Talk and Retirement, your no-hype source for financial advice in making informed choices about your retirement planning. Get on the phone to talk today at 314-931-5877 or text your question to 84126.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Now, here are your retirement coaches, Jeff and Aaron Lapidus.
Well, good morning, St. Louis, and welcome to Straight Talk on Retirement. I'm Aaron Lapidus, Vice President of JBL Financial Services, and I'm joined this week and every single week by my current and only co-host, Robert Markham.
Good morning, Aaron.
Good morning. Jeff will be joining us shortly. Just took a little extra breakfast break this morning, I guess.
He needed it.
That's right. We help our clients make smart choices about their money. The way we do that is by designing a game plan, a written step-by-step strategy, a real game plan that has several goals in mind. First is to preserve, protect, and prudently grow the assets our clients have taken their lifetimes to accumulate. Second is to deliver a reliable stream of income, one that they can count on to do all the things they'd like to do in retirement. And third is cost-effectively addressing their health care needs, like helping individuals enroll in Medicare and choosing the right plan to couple with their Medicare coverage. And after they're done enjoying their assets, we show them how to pass it on to their loved ones, whether that's churches or charities, family or friends. Good morning.
And how's it going this morning?
It's early this morning. I know many are we're probably expecting the garage sale. Maybe you'll find a few tips and tricks from us this morning. Unfortunately, unrelated to all of the deals around town.
Tips and tricks.
Tips and tricks. That's what we're here for. And, we really wanted to start off the show. We received quite a few emails and questions over the last week with a lot of variety. So we thought that we would take a few minutes to go through our mailbag, start the show off with a couple of light questions, but ones that we know many people headed into retirement are thinking about.
Absolutely. And Frank wanted to know, well, he's got a couple of comments and a couple of questions, and I have enjoyed listening to your show for many years. It has improved dramatically since Erin has joined you. Her explanations to questions are both easy to understand and insightful, and I have a bunch of them that are related.
Oh, it's going to be good. He must have written this one to my dad, unless he was already writing it to you.
Frank is turning 70 on July 3rd and has not yet applied for his Social Security benefits. He understands that it's mandatory to start taking them. Do I need to do anything, or will Social Security send me the money automatically?
Wouldn't that be nice?
It would be great.
They
everyone sends it automatically.
Start doling it out to you. Unfortunately, Social Security will not automatically start your benefit. They will automatically send you a letter saying you need to start your benefit. But what I would suggest doing is you have the ability to log on to the Social Security Administration's website, which is ssa.gov, and you can apply for your Social Security benefits right there. You can do so up to 3 months prior to when you'd like those benefits to begin. So if you were looking for your benefit to begin in December, the earliest you could log on would be September this month to apply for those benefits. If that's the earliest, so if you're wanting them to apply wanting them to begin next month, you can still log in right away. The other nice thing that Social Security does is it attempts to honor the date that you request. So what that means is if they can't process your application in time, let's say, for example, Frank wanted his Social Security benefit to begin in October and he applied today. If Social Security can't get the benefit to you by October when they send benefits, then what they will do is send you 2 benefit checks in November. So although you won't have access to the cash flow in October, they will make you whole by, sending you 2 Social Security benefits the next month. The important thing and the reason why Social Security can't just send the money out to you is because they almost in every case require direct deposit. So part of the application process when you log on to the website is to input your checking information so they can direct deposit for you. The other piece that many people have questions on, I didn't see Frank ask this one, but unfortunately they do not allow you to withhold taxes in the initial application process. So after you've applied and been approved, you then have to go back and request that Social Security taxes, or that federal and state taxes, be withheld from your benefit, which we always recommend that you try and do.
I think that covers his query. He's got one more, though. I have been covered by Medicare and a Medicare Advantage plan since my retirement from the police force at 65. Will I continue to send Social Security checks quarterly to pay for my Medicare Part B premiums?
This is a good question, and no, you won't have to do that, because what will happen is Social Security will automatically switch over your Medicare premium obligation from a check to being debited from your Social Security check every single month. So one other piece here that I would make mention of is if you happen, as Frank already knows, and many people on Medicare but not taking Social Security already know, they're paying those premiums on a quarterly basis. Don't try and figure out what your payment should be and then wait for Social Security to flip the benefit over. So, for example, every quarter has 4 months, or 3 months rather. If you only pay for 2 months and are expecting Social Security to take the money out of the third month, I would not recommend that, because if they aren't quick enough on the draw to get everything set up for you, then you will have missed a Medicare Part B premium payment. So it's easier and more effective, in my mind, just pay the bills as they come. But as soon as you see that your Social Security has been approved, you'll see any credits added back to that Social Security benefit if you have overpaid by mail with your Medicare premiums.
Gotcha. Now I have an easy layup for you. And this is the last one.
Last question.
When do I have to start taking my RMDs from my IRA plans?
Well, Frank, I think you mentioned you're 70 years old. On July 3rd, what kind of baby is that? An American baby? 4th of July, just the day before?
Patriotic baby.
A patriotic babe.
Baptized in the Star-Spangled Banner. God bless him.
Well, you won't have to start taking your RMDs for another 2 years. 72 is the new age of requirement. And I think, Rob, you've talked about this a couple of times on the show before, which is that the year that you turn 72, you are required to take your required minimum distribution, but you actually have all the way until April of the next year. So in Frank's case, he's 70 this year. That means in 2024, it'll be his first year that he'll need to take a required minimum distribution. He can take it in 2024, or he might say, I want to hold off, I'm going to take it next year, but then you have to take 2 because you're still over the age of 72. So you would have to take 2024's required minimum distribution and then 2025's.
And they base the withdrawal amount on the account value before he turned 72. So it would be December 31st of the prior year.
That's correct. However, they recalculate it every year. So your initial required minimum distribution is unlikely to stay that way for 2 reasons. One, as you get older, the percentage increases in terms of how much you're required to take. At 72, it's just shy of 4%. But the second calculation, as Rob just mentioned, is they're going to take the account value on the last day of the previous year. So as your account fluctuates, it goes up, and you have a higher percentage, your required minimum distribution is going to continue to rise. Or, in some years, for example, if we look all the way back to 2018, when we had a 20% drop in the market at the very end of the year, people's account value had drawn down. So regardless of what their percentage was, they saw a smaller required minimum distribution over the course of the next year. This year was kind of the inverse of that, where we had a nice run-up all of last year, and we've seen a drawdown, but you're still required to take the larger amount, fortunately or unfortunately, depending upon your needs. Good morning, Dad. Welcome to the show.
Good morning.
Good morning.
Nice to see you.
Nice to be seen. Thanks for letting me join you this morning.
Well, indeed. And you know what the great thing is? We have others joining us, too, because we have a couple of text questions.
Fabulous.
All right. Good morning. If you go on Social Security income disability and after a few years no longer qualify for disability benefits but are 62 or older, can you still choose to delay claiming normal Social Security income until full retirement age? Yes. If you are taking Social Security disability and then you stop because you're no longer considered disabled under Social Security standards, then you do not have to switch over to your Social Security, your normal Social Security benefit at that point. So we could use the example, the texture's 62, maybe he's completed, he's recovered rather, not disabled to the point where he can perform no jobs. If he doesn't need to take Social Security at 62, he just won't take the normal benefit and he can wait. However, most people end up staying on disability from the day they become disabled until their normal retirement age, and because your disability benefit is the same as your normal benefit, you don't see any fluctuation or breaks there.
Yeah, I think that's just a hopeful text.
Could be.
Yeah, to be in a situation where you can qualify for Social Security benefits, Social Security disability benefits, you're typically not going back to work.
It has a pretty, unlike private disability benefits that you might be able to access through your group, through your employer rather, or privately if you'd like to purchase those benefits, like you're a sole proprietor of a company, of an organization. The standards are much higher for Social Security disability. You have to show that not only can you not perform your job, but you can perform no jobs. So you can't do any work, and that's what qualifies you for the Social Security disability benefit, which is why it's pretty lucrative. They're going to give you your normal retirement age benefit whenever you qualify.
Right, and it's just an easy switch over when you hit retirement age because then you just switch from SSDI to SSI.
That's right.
Very good. Any other texts?
No one else yet this morn.
That sounds fine. And I'm sure you reminded everybody that all of our clients are folks like them. They're our listeners.
That's right.
They're 55 and older, they're getting ready to retire, or they're already retired.
I think I might have skipped that part in excitement of talking about Frank in that email because he had a lot of good questions. Thanks for bringing that around.
Sounds good. It's extra. Well, good. I was going to say, I know that one of the topics that we wanted to talk about today was a referral that we recently received. Somebody that we visited with last week, Sally, who is 67 years old. And she happens to be the coworker of, or was previously the coworker of one of our clients. She's also a widow, and her husband passed away about 10 years ago. She's married. She has 2 children, and each of her children has newborn babies. Kind of neat.
She has 2 married children because, unfortunately, her husband passed away, right?
Yes,
okay.
Exactly. Yeah, her 2 children are married, and each of them have 1 child.
So Sally,
it's a 2 and 2.
Sally has 2 grandchildren.
Yes.
Wow, it's nice.
Yeah, I still talk to her though. It was okay. So she had retired from full-time teaching a couple years ago, but she currently does work part-time in the teaching profession. She is getting a pension from the teachers and also her Social Security benefits at this point. And what's neat is that between all 3 of these sources, they're really meeting her current income needs. So,
nice.
As we usually do, and Rob was with me in the session, we sat down and I just said, how do you hope we can help you? And, what she had done was she identified a couple things for us, right, Rob?
Yeah, absolutely. She has $800,000 in mutual funds between 3 companies. Assets are being held at 3 different companies, and she doesn't currently need the income from these to assist in funding her living expenses. So she's a rock star.
Absolutely. She really meets that definition, which is someone that has more cash flow than they need to maintain their lifestyle. And so kind of cool for her because this is all after-tax money that's growing. But certainly having 3 sources was one issue, getting statements. Again, unlike many folks that we see in folks may not realize this, but when you're purchasing mutual funds, you can do it one of two ways. You can either do it directly through the company, we call those direct accounts, or you can do it inside of what we call a advisory or brokerage account, which is one that can hold funds from many different companies.
So it sounds like she is probably holding three different types of three different fund families, rather, which is why
Yes.
she had to keep them all separate, because they were with those fund families versus using an account which could hold them all.
Right, and so obviously administration was a minor issue for her, but one of her big issues was income taxes. She'd indicated when we looked at her tax return that she had a nice tax bill last year of about $13,000 that she really wasn't expecting, and as you mentioned earlier, honey, about our last texter, there was a big run-up in the market.
Right.
And so what happened is that she wasn't really ready for a big tax hit, which really came from capital gains and dividend income, which I identified by looking at her tax return, where she had about $49,000 in long-term gains and dividend income. And then to put, if you want to say, to add insult to injury, she didn't have cash to pay for the taxes. So what she had to do was to make some more sales of those funds to generate the cash to pay the tax.
I would say it certainly in this situation probably feels like insult to injury, because you had a
Right.
huge run-up, and then by the time April rolled around, we had seen a pretty big drawdown in the market. So remembering those $50,000 of gains, or maybe part of those gains had evaporated by that point, having to pay taxes on them, is probably a little unpleasant.
Yeah, it was a see ya moment. But and in her current situation, she'd identified that she has about $6,000 in what she considers her vault savings, but she really uses her checking account as her kind of capital account, where she had about $15,000 in there. But really not a lot of cash on hand considering her current mutual fund situation. Then we also, and before we talked about what were some solutions about that, we talked about some other goals that she had, right, Rob?
We did. And one possible move that she sees coming in the future is she really wants to go from a 2-story condo to a single-level living space, which is understandable.
Exactly. And she also identified for us that she could need an additional, maybe as much as $100,000, so that on top of what she has in her current mortgage in terms of what she would sell it for, so that she could be really debt-free again, have no mortgage payments like she is right now. For this new property. Naturally, the question really comes, where did it come from? And so, unlike most of the folks that we work with, and Aaron, we talked about this also a little earlier, yesterday, we're not talking about this lady's retirement assets. She really has pensions. She didn't put a lot of money away in a 403B plan. And so I think she had a total of $8,000. So this really isn't a source where most of our clients, they really have most of their money in retirement accounts and not in non-retirement accounts. Obviously, in her case, when her husband passed away, he must have had a fair amount of life insurance, which is able to create this capital for them, which is kind of a neat thing. And then certainly she was also interested in, her third goal was avoiding probate on the transfer of these non-retirement assets to her children and to the angels or grandchildren. What we found was, in reviewing the account statements, was that not only were her bank accounts not in TOD, transfer on death format, but a couple of the mutual funds weren't either. So they would certainly be subject to probate issues. Pretty easy thing to deal with.
And no cost to fix it.
Exactly, and there's never any cost to do that. And I also asked her about the titling on her condo, and had she executed a beneficiary deed? And she said no. So I said, got a little work to do. The fun part about this again is that she doesn't necessarily need to create a trust.
She doesn't need legal documents. She doesn't need
But
additional legal documents to
right.
satisfy this, because her account paperwork and account updates should be able to handle this.
But, Rob, you probably remember that she did mention to us that her will was about 10 to 12 years old.
Correct.
So she probably didn't bring it with her, but I was pretty confident that she didn't have medical directives or durable power of attorney, which really weren't standard practice per se in legal documents that long ago.
And now it's really the two most important pieces that make up the will.
Right. And naturally, we were in a position where we could make some attorney referrals to her, but she mentioned that she had a couple of relatives that were lawyers, and I said, listen, if you can really lean on them to get your documents done and really do them quickly, certainly that would be a great alternative for you.
And, you know, I've been, in my watching of lots of CNBC, I've seen a few new commercials talking about online legal documents.
Right.
I wouldn't necessarily suggest that you use them in all situations, but for things like wills that can be relatively what you would call boilerplate, a medical directive and a durable power of attorney, as long as you feel comfortable, or you might just want to have a lawyer review those at a lower cost than having to draft them from scratch, that could be an alternative for people that are looking to save a little bit of money.
You know, honey, I think you make a good point here. There are lots of ways that you can save money in planning.
Mm-hmm.
Okay, obviously being organized is one. But skimping on the legal side doesn't make a lot of sense. Because the truth is that there are very few people that are really, truly, let's just call it vanilla. You know, I want everything to go to my kids. I want a certain percentage to go to my grandkids. There's always some variations there. And the truth is that the variations can come easily and quickly. I mean, if you have, you know, God forbid, in her case, let's just say that one of Sally's children has another child, and one of those happens to be a special needs child. Well, that just throws this whole idea of
quick legal documents kind of out the window, yeah. Very
much. And, you know, Susie Orman, I know some years ago, came out with, will in the box, and it was $20 or something. You go to Home Depot or whatever his home office, then go see it. And the truth is,
I think
it's really important to get legal. I mean, it's very important to get legal advice.
I think they've kind of expanded the field now, where it's like not a will in a box, but it's literally like a lawyer in a box.
Right.
You hire they have a staff of attorneys online that draft the documents for you. They just do it at a reduced cost because I'm sure they're using the same language and just replacing names. So to your point, if you have a more complex situation, is probably not the avenue for you to use.
You know, and the other thing is, we know many employers do offer prepaid legal services,
right?
As part of an employee benefit plan, and that's really cool because, again, you are meeting with an attorney
that you get to select. There's a stable of them that you can choose from, but you do get to select the one you want to use.
Absolutely, and I believe that a part of that service is getting a living will, basically in no charge, because that's really being tied into your premium payments every month.
And some of the prepaid legal lasts after you've retired for a certain amount of time.
Yeah.
So that's pretty nice.
But again, I think, I think it's like with your health. I mean, if, there is a point where you have to go to the doctor. You can't self-diagnose, and in our family, you can't mom diagnose all the time. So it's, moms tend to be terrific doctors.
Mom D?
Exactly. Which is great. So, again, in Sally's case, we're talking about a couple different objectives. Number one is, can we simplify record keeping? Number two is, how do we deal with income taxes? Maybe in a little bit more effective way, or possible. And again, I'd asked her, what other financial objectives do you have that require money in the next 2 to 5 years? And she really said at this point, because of my cash flow, it's so good that the only thing I would be really looking at is a condominium. And then obviously just making sure that everything is dealing with probate. But in her case, because of her asset size, and even with the cash flows that she had, I think long-term care planning is something that we really need to discuss as well.
Right, and also since Sally's about 67 years old, it's probably a good time to start talking about it.
Absolutely. And and her 2 grandchildren are basically under the age of 1 at this point, which is kind of cool. They're really new. And, as I mentioned to her that, you may not see, you'll be around hopefully to see them grow up and mature and people that, that you hope they're going to be. But it also wouldn't be a surprise if you decide to start started, beginning to pass assets onto them or planning to pass assets onto them.
Mm-hmm.
Because realistically, and she's in pretty good health, they're probably not going to be, or her children statistically aren't really going to be looking at inheriting those assets most likely for about 20 years. And wouldn't it make sense, just like if these were IRA assets, to include those grandchildren in those plans,
right.
getting part of that money directly? I mean, how could getting 50,000 or 100,000 or whatever it would be, a large amount of capital, in those years maybe have changed their life, or have had an impact to prevent them to be maybe more entrepreneurial, or maybe have the down payment on their house versus the old vanilla way, which was waiting for mom and dad to pass away, so that realistically they might, the grandkids might have to wait till they're their parents' age,
right,
in retirement to get money. So those were some kind of important things. But Rob, the solution for her, I thought, at least initially, in terms of income tax planning and maybe preparing to create more capital for her, should she find the right one-story condo to move to, really wasn't that difficult.
No, not at all.
And again, as we had suggested, instead of reinvesting those dividends, reinvesting those capital gains, what we do is just have them paid to cash. They're held inside of her account, growing, hopefully earning a reasonable rate of interest, over 0.1%, and really available for her to either deal with paying for income taxes if in future years she did have those same type of run-up of those assets.
Or a filling up of another bucket.
Exactly. Filling up that could be the down payment bucket.
Right.
Or the new furniture for the new place bucket, right?
Because you always need it.
Absolutely.
Can never have enough buckets.
But that
Never have enough buckets.
No, you can't. But that was kind of a fun thing.
Yeah, I think we should take our first break of the hour.
Sounds great. I'm Jeff Lapidus, the tardy retirement coach.
I'm Aaron Lapidus, the retirement coach.
And I'm Robert Markham, your on-time insurance expert.
And we'll be right back after these messages.
Now, back to Straight Talk on Retirement on the Big 550 KTRS. Here are Jeff and Aaron Lapidus.
I like this song. I'm sorry I picked it.
You must really like it.
Come on. This is one of their classic songs.
I'm just saying you make mention of your love of it every...
Good thing they cut it off. I could have listened to the rest of it,
I don't
cool.
know if the listeners would have minded.
Let's go to the email bag, shall we?
Let's. And we received an email from Mary last week, and she is actively at work and participates in a 401k plan through her employer. She currently also has 3 other retirement accounts that are all still with former employer plans, totaling $68,000. And she says, quote, "My finances are a mess. I have money in 4 places, a lot of paper, and it is not easy to follow. What can I do to clean this up so I can feel more comfortable about things?"
It's interesting because, we did follow up with her and asked a couple of other questions, and she mentioned that she had met with her current advisor, one of the 3, I guess it is, who recommended that she create an IRA to receive all 3 of those accounts.
Sounds like it wasn't one of the plan administrators.
Yes, exactly.
Sounds like it was an outside advisor of some sort.
And obviously, that's certainly one option that she can do. Makes some sense. We just talked about in our last, about Mary in our last email. In our last visit, that we suggested the same thing. But but Mary, unfortunately, in this case, is still actively at work.
Right.
And
unfortunately.
Well, whatever. She's still actively at work, and she wants to reduce her paper trail. So, because they're in employer plans, which she can do, and frankly, that would be more effective for her, would be to do a rollover of those assets back into her current and existing 401k plan. She can't go from one we'll call them, what do we call that?
conduit IRA?
Well, it is a conduit IRA, but what I'm saying is we'll call it old. She
Okay.
can't go from a discontinued IRA to a discontinued 401k plan. You can't put assets into a plan you've already left.
Right.
But you can put assets into a plan that you're currently active in.
Right.
So moving 3 of these into her active plan, I think has a couple of not only good things that can happen, but big savings, right?
Not only big savings, but she mentioned, her finances were a mess and she's got money in a lot of places and she keeps getting paper on things and she can't follow it. So what this will do is consolidate everything into one plan that she, is currently contributing to so she can monitor it much more effectively.
So aside from the paperwork part, let's talk about a couple of other advantages of doing this. Number one, no question, is that when that money goes into her current plan, she adds that balance is also vested, which is good because it was her money and it will stay 100% vested to her. It's probably also a situation where, because it isn't outside, i.e. in the hands of an advisor, etc., there are going to be lower fees associated with it because they're not paying an advisory fee or a commission to purchase those products. Because we know when you pull money from 401k plans and you go into an IRA, you're actually liquidating those accounts and turning them into cash.
Right.
So even if she loved what she had and was rebuying what she wanted, it could be more expensive because, again, she could be working with a broker who may only be selling A-class shares.
Right, which is
front-load shares. Or even if she was working with us, guess what? She's got to pay us 1% a year.
in addition to whatever we don't use front-end loaded funds. We use the lowest share class available, which is usually what are called institutional shares now, but you're still paying an investment charge. So you're paying an investment charge and an advisory charge.
So what she really should be doing is, I would say, is talking to the advisor who happens to be working with her current plan.
Because there is always one attached to your retirement plans at
Right.
work.
And then all she would have to do is go to her plan administrator, request some transfer forms, also bring in a copy of those statements of those other accounts. And what would happen is that the money would then be transferred to income tax-free as a conduit between those 401k plans into the old ones into the new ones. And that'd be
Right.
great.
So there'll be 3 transfer forms to complete because there are 3 accounts that you'd like to move.
Yeah, so an easy solution, but also one that would be cost-effective, we think, for her, because if nothing else, at the end of the day, she's also going to save a $30 IRA fee, which all the custodians charge to everybody's IRAs
Well, what
for
if
reporting purposes.
What if one of those retirement plans she had already moved into an IRA? Could she move from an IRA back into a 401k?
Yes, she could, as long as she hadn't made contributions to that plan.
So in that particular case, it would be called a conduit IRA because it's literally just holding money from an employer-based retirement plan. You didn't make any additional contributions to it. For example, if in one of these instances, if Mary had been working, she was out of work, or maybe she did some self-employed work and wanted to make you still wanted to contribute to a retirement plan. If she contributed to the IRA that was holding the former 401k assets, she couldn't move it at that point. But if she hadn't, then it's still an option to get back into a new 401k if you have that available.
You know, that's a really good point, honey. And I was going to say something that we also see, not often, but it does happen, and it's primarily when people are retiring, is that there are folks that have loans against their 401k plans.
Right.
And once they terminate being a active participant in a 401k, they don't have a way
To pay the money back.
exactly, because we know that loan repayments are made by
The payroll deduction, just like
Exactly.
any contributions to retirement plans through work, are also only allowed through payroll deduction.
right. And generally, what happens is then she would have to pick up that loan as income in the next year, because once you default on payments, they become income.
That's a distribution at that point?
Yes, it's considered one. Now, there is a possibility, and we would say I don't want to say it's lucky, but it for her it could be lucky, what she should do is, let's assume she was in a situation with one of those plans like that, and it was the recent one, so it hadn't had a chance to basically default on that loan. If her new company, the one that her active plan, did permit loans, what they probably will also do is permit her to move that loan over.
So she carries the loan with her when she does the transfer.
Exactly.
She has of one of those three plans, there's still a loan against it. She could move that into her new plan if her new plan accepts loans, and she would just continue to make loan payments
through her current compensation, right? Just like she's doing today. So again, and I kind of made a note here, which was, are you kidding me? Moving the money out of those plans and into an IRA, which is ultimately where they're going to go, for her in both of these situations really wouldn't be the right thing to do. And it's something that we generally do not recommend to clients either. I mean, unless you're ready to leave.
Right, unless there's a reason. But I have a question about loans against your 401k.
Sure.
If you took a loan against your 401k because you're under 59 and a half, but you needed access to some of the money for a short period of time, what happens if you leave your employer before you're 59 and a half and you have this loan? Do you have the 10% penalty to pay? Or is because it became considered a distribution, or is it still qualified as a loan repayment, a defaulted loan?
Honey, I don't know the answer to that, but my sense would be is that since it wasn't an actual distribution to start
Initially,
with, and it was actually a loan, that it would just I don't think you're subject to 10% penalty, but that's a really good question.
So that's a CPA question we should probably come back to on. Okay,
yeah,
cool.
I think we should definitely write that question down and get back to it, but we would know the answer.
Didn't mean
we just
to stump you. We would probably never recommend.
Well, the truth is that we haven't seen one of these situations yet.
Right.
So it's always good to know. So guess what? Our listener will know, and the listeners will know.
That's right. I think we should probably take our second break of the hour.
Yeah, we've got about 15 minutes left in this hour. Do us a favor. Don't touch that dial. Aaron and I and Rob will be back right after these messages.
Let's talk about smart choices for your money.
It's Straight Talk and Retirement on the Big 550 KTRS.
Here are your retirement coaches, Jeff and Aaron Lapidus.
That's right. It's 7:50 here on the Big 550 KTRS. Talk Radio St. Louis. Woohoo!
You were in a great mood. That extra few minutes of sleep really helped.
I don't think so. I was up at 5. I wasn't sleeping. I was just
hanging.
I was getting ready to go out to breakfast.
Well, that's great because that's what I.
Nice.
Right?
Normally, I mean, I usually go to the diner it opens at 7, and your mom goes, "Oh, by the way, Aaron just texted you."
No, I text her because your phone is an expensive paperweight.
Yes, that is really true. But it's we just passed the 1st of September. 2/3 of the year's gone. 2022.
Hard to believe, isn't it?
Time flies when you're having fun and you're older. When you're young, time goes slow.
And they always say don't wish your life away, but then you do anyway.
That's right. It's youth is wasted on the young. Is this the year you're going to retire? There are many things to consider over and above and in excess of, do I have enough money?
Sure.
And, again, I don't think a lot of other folks talk about this. For us, these are really central themes. I like to use the concept of, I think there's really 3 basic areas that we're looking at. Number 1 is, where are you going to live? 2 is, what are you going to be doing with the time that you now recently have received because you're not working anymore? And then who are you going to be doing it with? I think unless you're in a situation where you've really taken the time to think about these questions and at least have a little bit of a game plan for them, if nothing else, I don't think you'll be as happy as you could be, right?
Well, right.
Especially because, let's talk about the housing side, right?
Where are you going to live?
Right.
Where are you spending your time?
Exactly.
Yeah. For example, a lot of people put off home improvements over time, or, not only home improvements, but maybe they have family in other places. They have children that have grandchildren that have moved away from St. Louis, and they want to be able to either spend some or all of their time there. Is now the time to make the move? Are you going to be buying something? Are you going to rent something? Do you know exactly where you want to be? There are a lot of questions to answer. And also, I think the nice thing is, just like with a game plan for your money, we don't necessarily have to make every decision up front. These can be made over time, but knowing that they're coming is really important.
Yeah, and then especially planning for the capital, like I had talked about in our last one. What other capital do you need to satisfy your financial goals? Certainly when it comes to making your home ready for either the long haul, that's a big deal. Putting prices on these, putting in time periods about when you think these are going to happen, and then obviously trying to figure out how are we going to pay for these. Are we going to draw money from IRA accounts? Are we going to accumulate cash? And we've talked many times, we often find folks that are getting ready to retire, and they're thinking maybe 1, 2, 3 years down the road. They have some debt. They would love to get rid of it. But we also know that when they do retire, they're going to be rock stars. They have more cash flow. They have more capital than they need. So in many cases, we're saying, hey, let's redirect above your match. Okay, always make sure you match the match, because that's free money
of your retirement plan contributions.
Right. Instead, let's take that money home,
right,
and direct it into debt reduction.
Or we could look at this on the flip side, which is why planning is so important. Which is, if we are meeting with clients or prospective clients that have a mortgage, but they're not planning to stay in their house forever, it isn't necessarily a priority to pay the mortgage off, because we know that either they're going to be carrying a new mortgage elsewhere, or the mortgage will essentially be paid off at the sale of the house. So so I think that, although these topics sound like soft science as opposed to the hard science of how much cash do I have, how can I create an income stream, they really do flow together, because the science part of things, the cash flow, can be much more effectively planned if we have an idea of what those plans are and when cash flow is needed for them.
Yes, and I think it's curious, and at least something that I have begun to do, is when we have clients that become new grandparents, especially for the first time, and sometimes the second time. Generally, we know, and if they're in a situation where they don't have, those grandchildren aren't located here in the city, my real first question is, well, how long are you staying here? No, I mean, well,
sure, most of them do end up either part-time or full-time wherever their grandchildren are.
That's right, and it's a thing about how long will it take us to get out there, what's going to be the cost to move, et cetera, to do that. Or do we retain our home here, and how often do we want to be there? Right. What are the conditions going to be like? And so you're really talking about the opportunity of having really dynamic change in your life and thinking these things through a little bit, or if nothing else, dreaming about them. What could happen? What would be the possible outcomes? How would I want to deal with that? I think can really save you money over a long period of time, because if you're in a situation where it's like, well, do I downsize? Well, there's no downsizing anymore. It's same sizing. I mean, you may change the number of stores in your home,
or whatever,
but guess what? You end up paying the same thing. So does it make sense to move? Does it make sense to then have to buy new furniture and do upgrades and do the changes if, in fact, ultimately I'm going to be moving to another city, to another place maybe?
Also, I mean, literally what you talked about when our other email from Mary, I'm sorry, the visit that you and Rob had with Mary, where she had all of these dividends that are being reinvested, nearly $50,000 a year. If we know, just like we knew that Mary might need a $100,000 down payment on a house, well, we didn't know exactly the timeline, but we had in 2 years the full down payment potentially just with dividends going to cash versus
assuming
being
the markets
reinvested.
continued to
Right.
work the way they were. But
We're going to
you're
have
right.
some amount of cash that's now free and clear of taxes because you already paid taxes on it.
Well, and the truth is it makes the decisions easier.
Mm-hmm.
Right. I mean, Mary didn't want to borrow money, and in this case, she didn't have to. So, that's a big one, which is, where am I going to live? And I guess the second one will be, who am I going to live with? I mean, literally. I mean, is my marriage happy?
Wholesale life changes. No work, no wife.
In our second hour.
Yes, and, there is, and I mean, I don't have, listen, I can talk about this because it isn't me, but many people get, I'll use the word roped, okay, because sometimes it's voluntary, sometimes it's involuntary, of becoming babysitters.
Oh, we
Okay.
thought you were taking a different turn.
Right,
on
I
that.
thought-
No,
was going
I'm
there.
I'm still in the dreaming for grandchildren stage, honey, and you're really not off the hook. But at this moment,
Why, thank you.
but is this something you're signing up for? You're wanting to sign up for, and
You
usually
become default.
usually the grandmas are like, "Yeah, I love it every day." No, you don't.
Right,
I mean,
they're small,
and
and
maybe-
you've gotten
and-
older. You
and
got
the
to
tr-
pick them up.
And the truth is, maybe you do. But is this something that you want to do? And the truth is that should you have rules? I mean, I think there have to be some rules.
of course.
Right. Rules are important, and just like anything else, we do have one other major rule.
What's that?
5950, which means in about 30 seconds we're going to have to get off the air. But we'll be back on for another hour on Straight Talk on Retirement.
I
You're
think
on the
we
Big
should
550 KTRS. Right?
Absolutely. I think we should let people know that they can absolutely call in if they have any questions. 314-931-5877.
Or 84126 on the text line. Or if you're so inclined, you want to come in for a coaching session, guess what? Just pick up the phone and give us a call, 314-863-0008, or go to our website, hit the Contact Us section, which I know Aaron talked about earlier.
Forgot. Bring it up at the top of the next hour.
JBLFinancial.com. We would love to hear from you. Don't touch that dial. As you know, we're going to be right back after these messages.
Now, back to Straight Talk on Retirement on the Big 550 KTRS. Here are Jeff and Aaron Lapidus.
Hour number 2.
Is that your
I'm
opener
listening to
from
that
now
part
on?
of the rift, honey. I'm sorry.
I'm sure the listeners enjoy.
It's a great song.
It's a great band.
Yes, they are. Even if they are North and they can't play baseball very well. So, Chicago. Well, great. Welcome back to hour number 2. Just as a reminder for our listeners, and I think most of them are still sleeping because we're usually on starting at 9 o'clock.
Right, so we've now garnered the yard sale listeners.
Yes, we have. And we'd love to hear from you. Our phone lines are open. We are live and local, as you can tell, 314. What's the number, honey?
931-5877.
Thank you. 84126 from the text line.
From
Love to hear from
ABC
you,
Sports.
and not really from the sports people, but
Certainly
it's okay.
not ABC Sports.
It's the KTRS gremlin. What can I tell you? So,
well, it is the first week of
yes,
football
and it is
weekend.
Missouri, Mizzou football, which is cool.
Indeed.
The other thing is I do remind folks that next week we will also be on at 7 a.m.
Bright and early Mizzou football.
That's
Start
Took
your
our
morning
spot.
right.
Right, get it going.
I'll be
the
sleeping
right way.
over and, be in the lobby and
With tips
make
and
sure that
tricks.
I'm here on time so that they don't leave
On
me.
time, right. So
They
we
don't
let you
leave
in
me.
the studio. This time was
I will not be on holiday. But again, welcome back to hour number 2. For those folks that are new listeners, Aaron and I are called the Retirement Coaches. We help our clients make smart choices about their money. The way we do that,
by designing a game plan, a written step-by-step strategy, a real game plan.
that has several goals in mind. First is to preserve, protect, and prudently grow the assets our clients have taken their entire lifetimes to accumulate. Second is to deliver a reliable stream of income, one that they can count on, so they can do all the things they'd like to do during retirement.
And third, if cost-effectively addressing their healthcare needs, like helping individuals enroll in Medicare and choosing the right plan to supplement their medical coverage.
And then when they're done enjoying their assets during their lifetime, we show them how to pass them on to the people they love, whether it's their spouses or children, grandchildren, churches or charities, whoever it might be. Well, Uncle Sam or the tax court's taking a big bite out of their money. And as their wealth managers, Aaron and I watch their money every single day to make sure they're staying on track. And that's why they call us retirement coaches. And we're also joined this week and every week moving forward by Rob Markham, our insurance specialist in the office.
You know, we have a great text question
Fabo.
that has just appeared. Can we take a 457 state-funded retirement plan and convert it into investment farmland like in exchange without paying taxes?
No.
Aren't there some, like a very, very small handful of custodians that will allow you to hold real estate inside of an IRA?
Not
Investment real estate?
Very few custodians.
Like you can't go to, I'm sorry, you can't, the people you hear on TV with the Lion and maybe they have headquarters here in some cases, a couple of companies. You can't go to or local banks and open up an IRA to accept those 457 funds and then buy the farmland because unfortunately those custodians don't allow you to hold physical assets inside of your IRA.
That's correct. So it's very difficult to do, not something I would certainly suggest that you would consider. And if it's even possible to do, which is cool. Again, our text line is open, 84126 or 931-5877.
Remind me, can I use my HSA to pay for medical supplies? Yes, you can. You can pay, you can use your HSA dollars to pay for anyone that is on your tax return. So it doesn't have to be your personal HSA to use for your own money if you're married or you have a child. And you all file taxes together, you can use HSA dollars to pay for their medical expenses.
Super. Yeah, HSAs are just, they're the trifecta. The money goes in pre-tax. If you're using it for legitimate medical and other approved deductions, comes out tax-free and the money grows income tax-free also. So it's great.
The other important thing to remember is that there is on the IRS website is a list of approved expenses for HSAs, HRAs, FSAs, all types of
all
types of healthcare savings accounts that allow for tax-free use of money. Inside of them, there's a list of approved ways to spend the money. So if you ever are unsure because it's not a prescription or a visit to a doctor or durable medical equipment like the texter just mentioned, you can look at the website, and if it's approved, then you could show, if the IRS ever questions you, you'll be able to show it.
All good. Very good. Very good question. We do appreciate that. But we do want to get to we'll call it our life insurance section of the week.
Let's do it.
With Rob.
Let's go.
And so, Rob, talk a little bit about Sally and Rich, who you visited with this last week.
Super nice. Great people. Rich owns a farm in Illinois, and Sally is a homemaker. And they came in for a coaching session this week, and they're doing great. And they're just on course, dotting all the I's, crossing all the T's. But what really concerns them is Sally's mom. Sally's mom, Janice, recently began dialysis treatment. So while Sally and Rich are naturally hoping for the best, they've begun to think and plan for paying for final expenses. I inquired if there was any insurance that Janice may have had, and there was none.
And, that isn't really an unusual situation at this point. Parents are getting older. Quit staring at me, Aaron. Okay?
Oh, no.
What?
Evil
I would
eye.
never. I wasn't even listening to you.
That was just such a layup thing. It's such an easy setup for you. And but sometimes folks are getting into, and their health can decline. In this case, dialysis treatment is one of those things that,
pretty serious.
It's serious, and obviously it's one of those things that you can obviously be automatically. It's almost an automatic qualifier for Social Security disability income
because it is
it's
debilitating.
But it's also an automatic disqualifier when it comes to life insurance.
Right, because again, it's debilitating.
And so, even attempting to go through underwriting standards would be very difficult. But, the two of them, and it is unusual for them, to think about, well, mom could pass away sometime in the future.
Right.
We've got we've got this, we have a farm, but mom doesn't have a lot of assets. They're going to be, we're going to have to sell things off. Does it make sense? How do we come up with the cash to pay for funeral expenses? And, of course, not being able to do the normal underwriting route, we had to look at some other options, right, Rob?
True. And, as you said, because of the underlying health condition, it does make her uninsurable under normal underwriting standards. But I knew that she would qualify for a special type of life insurance that's called final expense policy. And a final expense policy can be guaranteed acceptance without medical exams or questions.
Very similar to what we're seeing on TV, right? Lots of stuff. No, we're
Lots
seeing
of final expense stuff.
We're seeing Jonathan on TV, and we're seeing folks from AARP on TV talking about guaranteed acceptance life insurance.
Right, get a policy, no doctor's questions.
So, Rob, it may be a guaranteed acceptance policy. There isn't any medical exams or questions, but there are some hitches, right?
There are. And because of mom's condition, she would have what's called a graded death benefit. And that basically means for the first 2 policy years, if mom passes away, all premiums would be returned to the beneficiary plus an additional 10% bonus.
And they do disclose that on TV, but it's in the type that's so small
you cannot read.
And you also don't. They also never discuss it. So that's something. So this is really a standard provision by the insurance company. Say, hey, we'll take you,
right?
But for the first 2 years, and frankly, there are even some limitations. If you're in the hospital, they're not taking. Okay. If you're in a nursing home, they may or may not take you. But there are a couple of limitations. But generally, again, there's no underwriting.
Also, they disclose those limitations on the front end. So once you're reading through the exclusions, if you see that you fall under one of those exclusions, you're just not going to qualify.
Well, exactly. And just sort of like long-term care, there are some questions that are asked for general questions. But again, they're not qualifying questions in terms of like a health exam is.
Right.
But after the second policy year, you get full benefits.
Absolutely.
It's a step up, right?
Indeed.
And the other thing is that, as we know, the premiums are level. Wherever you start, those premiums are level, and they're guaranteed for life. So, Rob, you did call the 995 people, right?
I did. It was one of those things where you want to know if it is as they say it is, and sure enough, it was not.
You didn't talk to Jonathan, though, did you?
You didn't get a direct
asked for
line.
him, but he was unavailable. He was on his lunch break.
But you did talk to the folks.
Who is Jonathan?
Jonathan is the spokesperson for.
What is his last name? He's famous, right?
I'm not going to.
We can't.
You can't disclose.
We're not going to go. We're not even talking about who the company is. So
my fault. Apologies.
That's we're protecting the names of the innocent, but they're on TV all the time, and it's cool. It's their favorite, and they all talk about 995. Now we'll get later into what 995 really is, but you did call and inquire about a $15,000 death benefit for Mom Janice, who's currently 70 years old.
I did, and I quickly discovered that the premium for Janice would be, from the $9.99 people, would be a lot more than $9.99. It would be $149.25 a month, or almost $1,800 a year annually, versus a competitor whose name we won't give out, offering the same policy for $112, or about $1,350 annually. So it was a savings that was quite sizable, almost 25%.
That's pretty significant.
No, it really is significant, and obviously the other companies that you looked at were A-plus rated companies, which is important, so they're solid insurers. But I think and you also realize you're not paying for TV advertising, which is fine. But let's take a minute before we get, and if you don't mind, get a little deeper into these numbers. $1,355, let's call it $1,400 a year. That means you really have about an 11-year break even. So, again, these contracts are really there for folks that unfortunately are going to be possibly getting final expenses very quickly, and obviously somebody under kidney dialysis, they generally don't have a 20-plus year life expectancy. So this could be a good deal, if that's a nice way of putting it. And we had talked about in the past, Rob, we've seen a couple situations here where even though we're only talking at this moment about Sally and Rich, Rich could have, or Sally could have siblings, where the siblings are getting together and saying, hey, you know what, we can take care of this, instead of us coming up with the $15,000 to deal with mom's final expenses, which they may be forced to do. Wouldn't it be maybe smarter for us to split the bill? So like in this case, if there were three of them, we're looking at about $30 a month.
Per family member.
To help insure mom.
And, it's a great plan because it allows you to deal with the final expenses in a way that doesn't put you in a bad situation, where you have some baseline level of coverage for those final expenses when you have an underlying condition that almost makes you uninsurable.
And I was going to say the minimum purchase on this coverage is usually $5,000. Is that correct?
That was the lowest that from the 995 people. That was the lowest, and even on the other side of it with their competitors, that was the lowest I saw that you could begin coverage. And the maximum, I believe, was 20. So they keep you in pretty defined corridors.
And you could, and let's put it this way, the other thing is you could stack these policies if that was something that you wanted to do. What we're not really talking about here, and I know that you want to bring this out, is, obviously this is an older age contract, but there's also a limit, which is either age 80 or in some states age 85, where that's the maximum age that you can purchase this coverage.
So that means you're on a clock here.
Right. And, these folks, obviously mom and dad were, mom was really not that, she's 70 years old. It's her health condition. 20. That's right. It's her health condition that really drove this kind of decision. But, we talked about this, and, look, so I know your grandma's listening, okay? But when I started looking at this, grandma almost had her, she's, next one is a big 9-0 for her. But I was, I just thought to myself, I didn't pay attention.
No.
5 years ago, 6 years ago, about this, and would it maybe have made sense for us to do that at this point? Now, fortunately, she's been alive, and she's going to
live forever.
She'll be, hopefully, it's going to be her and Moses. But with someone that has a serious condition like kidney dialysis, it's not so easy, right?
No, it's not. So it's nice. So this would be another example. We've talked about this a couple of times about how we feel very honored to be brought in on the ride and on the journey of people's retirement. But these are things that we're also here for, which is to help you with other facets of, not only dealing with financial issues, but, we were here to give a solution where they thought there was none.
Yes, which was kind of neat. So let's get back to the fun of this $995. So, Rob, the $995, that really came out to be a rate per $1,000 of coverage for somebody age 70, right?
Right, and you can't just buy $1,000. Not that you would, but I mean, you can't. They have you, as I said, in clearly defined corridors of the minimum being 5,000, and the maximum being 20, and then you have the age, we'll call it variable, that goes into that equation as well. So they've got it pretty much within those tightly defined corridors of what you're able to buy and how much.
Well, also if you
the $995 is very, I'm not going to say it's deceptive, but it's not
Well, it's to get your attention. I mean, that's
Right.
well. The truth is, it's there to get your attention. And
But the competitor that you selected, or that you recommended rather, was $750 per thousand of coverage.
yes,
Basically.
that's right.
If I know you scaled the numbers up for
Right.
the amount of coverage that we were purchasing, but if you're looking at it on
If
a
you-
per thousand
exactly.
level, so $995 versus $750.
No, it was a sizable savings, and it was great because not only were we able to insure Sally's mom, but we were able to do so given the underlying health concerns and conditions at what I feel is and they felt was a very reasonable rate. So that was great. It's always nice to, leave people with a happy ending when they don't think there's an ending at all.
Right.
Right, and it wouldn't have been unusual, maybe, where. Well, it would be unusual for the owner, but let's say this was Sally's dad, and that maybe he had some GI insurance, and we see those typically in much smaller face amounts. Maybe it was only $5,000. He said, "Well, you know what? We might need 15, so why don't we stack a policy on top?"
So we only need 10 instead
Exactly,
of the full 50.
and if we use the same numbers here at $750 per thousand, you're talking about $75 a month to buy 10,000 of coverage, which, frankly, is it's not a great deal, but in this case, it's a really good deal. So,
Literally the best
something
deal
to
in
think
town.
about, and
Right.
we'll probably, we're going to talk. We'll be talking about this type of coverage more in the future because, truthfully, people are living longer.
They are living longer, and also people are becoming much more cognizant of the price of
Yeah.
final expenses. So this might be for some people a more cost-effective way to help deal with those expenses.
Absolutely, and purchasing smaller face amounts of coverage is not easy to do, and this
No, it's
might be
not.
a good alternative for them.
Let's take our first break of our second hour.
Time is just flying.
Right by.
Sounds great. We'll be right back after these messages.
Let's talk about smart choices for your money. It's Straight Talk and Retirement on the Big 550 KTRS. Here are your retirement coaches, Jeff and Aaron Lapidus.
We're back with some more Straight Talk on Retirement. I'm Jeff Lapidus, the retirement coach, joined by
Aaron Lapidus, the retirement coach.
And Robert Markham, insurance specialist.
Glad you remembered.
It was a dramatic pause. Deciding what he
Sure.
wanted to say.
828 here on the Big 550 KTRS. Welcome back to Straight Talk on Retirement. Our phone lines are open. We're live and local. We want to hear from you. I couldn't talk any faster. 931-5877.
84126 on the text line.
84126 on the text line. I was practicing my radio
Throwing
voice.
people off.
Thank you.
Right.
We're back. I'm here with the children. Yes, I am. It's time.
Is it?
Yes, it is. For our Smart Choices About Your Healthcare segment, sponsored this week and every single week for the last 8 years by
Aetna of Missouri, but Anthem has become a more recent sponsor.
Yes, and we want to thank both of them for their continued support and sponsorship of the show because they also do business with the #1 Medicare agent in the state of Missouri, my oldest prodigal daughter.
That would be me.
That would be you.
It's got to stretch out a little bit. All right.
What are you going to talk about today?
So I received an email just yesterday afternoon that...
Was that one of mine? Did you steal it?
No, this is legitimately, it says Aaron,
Okay.
comma, Aaron. He
Sure.
sent it to me and everything.
Aaron.
Right. This isn't a common... This is a common question, but it takes many forms, so I thought that this would be a good thing to bring up before open enrollment.
Okay.
Okay? I'm going to leave you in suspense because you're looking at me like I'm crazy. So recently, my emailer says, I've been reading some horror stories written by physicians who graduated from Notre Dame to the effect that United Healthcare is denying everything these days with respect to various surgeries. He cited a comparison where United denied 86% of one particular surgery versus other health companies only denying
They were
it
a sponsor
between
of the show. That wouldn't happen.
6 to 12%. Right. We'd have a chat. No.
Right. Better believe it. We wouldn't put up with that.
The texture hasn't had any surgeries, but the email or hasn't had any surgeries, but he just wants to be ahead of the game, and he wants to use open enrollment as an opportunity to compare other insurers because he currently utilizes a Medicare Advantage plan. So
Smart.
there are many other Medicare Advantage plans out there and available for use, and also your opportunity to switch to one of those plans is rapidly approaching. October 15th is the first day that you can initiate a change.
But if I may,
please.
If I may, there's only 4 companies here. There aren't that many that do business, really, or 5
but they're
in the state, right?
Aetna,
Missouri, if we're talking about.
Aetna, Anthem, United, Essence. I think that's
exactly
pretty close. Cigna offers a plan now. They're 2 years in. There aren't endless insurance companies that offer Medicare Advantage plans. Now they've come out with some other ones, like Mercy Health Systems has a Medicare Advantage plan that's geared towards their network.
Yes.
So we do have some variety, but within each company, they offer 4, 5, 6 different plans potentially. So you do have a lot of options to choose from. However, our approach is always to look at your physicians and your prescriptions and see, one, are your prescriptions covered in a cost-effective way, or at the minimum, are they covered? Then secondly, do your physicians all fit in the network so you don't have to fight against your plan? You can continue to use the physicians you'd like to use. But in some cases, people have heard things they have certain misgivings about certain insurance companies. So we do have the opportunity to say, okay, maybe you're not going to save as much money as you possibly could on one plan, but if you have a preference for one or the other, we can make that happen for you, given that you understand the limitations of the plan. But I really wanted to go back to the comments on United Healthcare, which is just that physicians are great at being physicians. They are not the plan administrators, nor do they generally deal with insurance on such a minute level that they're going to look at the difference between Medicare approvals for surgery versus private plan approvals for surgeries, because really at the crux of it, every single one of the insurance companies that we just rattled off, and I think there are a few more, so apologies if we've left any out that you might be using, they have to follow all of the rules and regulations that Medicare sets out, which means in most cases, if your physician says that you need something, a surgery, a procedure, a specific medication, if your insurance company denies it, you get one denial, then you can appeal to the insurance company directly. But after that, if you get a second denial, you appeal directly to Medicare, and they determine should the insurance company be covering this for you. And just like in many other situations, Medicare sides with the enrollee. They do not side with the insurance companies. So if your physician has written a reason as to why you needed this surgery, there may be some hoops to jump through, meaning, for example, if this is an orthopedic surgery, they may request an MRI or a CT or physical therapy in advance of you having the surgery completed, but that's not a denial. That's just a procedure process. So I would shy away from looking at national statistics or national information about healthcare in general, and I would also shy away from looking at it in regards to Medicare Advantage plans in general, because St. Louis and the metro area in Illinois have a really unique position in the healthcare market in this country. I think we have we have so many large hospital systems that the insurance companies are they prioritize creating managed care plans, which are those Medicare Advantage plans, for people in this area. That means that if you look across the entire country, we have some of the lowest maximum out-of-pockets available. We have some of the best benefits available. And then in addition to that, you have some of the best extra benefits available, which aren't necessarily medically or Medicare related, but vision, dental, hearing, free gym memberships, extra money for over-the-counter benefits. So I would say, and we've used Grandma as an example twice now today, but when Grandma moved from Pittsburgh to St. Louis, Grandma was on a Medicare Advantage plan through Anthem. They call it something, I think they call it the Blues up in Pennsylvania.
Right. Exactly, Blue Advantage. Something
like $8,900 maximum out of pocket for an HMO-style plan that she was paying a premium for. So not only was she paying premium every month, her maximum out-of-pocket was close to triple what some of the Medicare Advantage plans are in this area, and
no premium.
In addition to that, no premium, and Missouri and Illinois even offer more than one PPO style plan with no premium now at this point.
Got a big hug from Grandma.
Right. Well, I mean, we saved her like $6,000 just in the move every year if you hit your maximum out of pocket, which unfortunately she's to the point where she's hitting it pretty often. So those dollars,
because of the meds,
right, and those dollars do make a difference.
Plus, she has these boyfriends that are ambulance drivers. Fantastic. You know what I mean?
You made
People
that
are listening.
joke.
They're like, you know what I mean.
Oh, well, we did just get a text, and I would like the other side to be heard, especially on United Healthcare's behalf, because we do represent them.
Yes.
Which is, my wife had a United Healthcare United Healthcare during cancer treatment. They covered everything. I mean, everything. Great company. So
absolutely, don't
everyone has a different experience with each each insurer. Your company's probably changed health insurance companies more than once over time. Maybe if your kid has had a different type of health insurance through when they get to university. So you have to deal with health insurance quite frequently, and I found that people have very strong opinions about insurers. But I would say that, we're just out there to find what's going to fit for you the best.
Yeah, one other thing I'd like to bring to light here, and we don't talk about this very often, and Aaron, you did refer to this a little bit, but the health insurance networks, physician hospital networks here in St. Louis and in Illinois, Southern Illinois, where our clients are at, these are robust. They're huge. They're large. The doctors participate. The hospitals participate. So what's happening here is that what we're getting down to is really helping you choose a plan that fits those relationships that you have. People aren't changing their physicians. And I think that, and this is something that obviously, sometimes I am a little thick when it comes to things, but, I didn't realize truly that Medicare is the driver on health care when folks turn 65. I mean, I have been involved with corporate health insurance, helping set up plans for over 30 years, and it's called, and if you're working, it's the insurance company, they're running the show. What's covered, what's not covered, you can appeal, they're not easy to do. You're stuck with their plan designs. The holes are big. Deductibles are getting larger. Copays are getting larger. Out-of-pocket's getting larger. You go to Medicare, it's heaven. Government subsidized, plus you do pay a little premium for Part B, into a situation where it's covering 80% of your health care, not including your drugs. So what we're talking about, like you were talking about, honey, is that, when you do these, if you have issues, the insurance companies have to follow the Medicare guidelines because they want to continue to participate in the plan, to actually offer plans. So getting this matchup and doing these mixing of these things and relooking at your plan totally makes sense.
Absolutely.
And I know that, you and Frank are our internal Medicare specialists. You've got this deal all done. I mean, for folks that are you're going to be looking at, and you are doing this very actively because you're going to be able to talk about these actively in about 3 weeks. Comparing the plans to what the existing plans are, new plans versus the old,
right.
And then trying to figure out, has somebody stepped ahead of the other ones? Because the truth is that in the big networks, if I'm right, which is Aetna, United Healthcare, Anthem, you've got a really great cross-section of the same docs.
Of course, because like you've talked about in many occasions, Dad, the physicians follow the market.
Right.
So more and more people on a 3-to-1, close to 4-to-1 basis are electing Medicare Advantage plans now. So that means two things. The insurance companies want your business, so they're attempting to vie for the best benefits available, even if we're talking $2, $3, $5 differences between things, or $100 difference between things if we're talking about maximum out of pocket. And then on the other side, the physicians want to get paid. So they want to be...
They're following their patients.
Right. They
too.
want to contract with the plans that all of their patients are now taking. So really, in this instance, and as I say often, enrollees in Medicare drive the market because it's the largest insurance market out there. All of the insurance companies want your business, and they have very little that they can do to garner your business because they have to follow all the rules and regulations of Medicare. So they are constricted as to what they can offer you. They can nibble around the edges a little bit. So, of course, they're going to focus on network. They're going to focus on extra benefits. They're going to focus on prescription drugs, the places where they can really make a difference.
Co-pays, maximum out-of-pocket amounts, etc.
Exactly.
And I think it's a real fallacy for most things that you hear. Healthcare expenses and retirement. Well, you know what? We become the joy of modern chemistry environment here.
Sure.
With medications. But the truth is that every Medicare plan that I've seen so far, the out-of-pocket maximum with these Medicare Advantage plans is like $3,000.
Right, but that doesn't include prescription costs.
Right. So setting that aside, it's no different actually with your company healthcare plan. Most people's deductibles in their company healthcare plan is a lot more than $3,000. So
right.
You're actually looking at a more controlled situation. I don't know. Again, you and Frank have obviously we've got thousands at this point of St. Louisans and folks in Illinois that we're helping. By the way, Rob, it's called Illinois. There's no S on the end.
Wow. Just calling
Illinois.
It. There you go.
You got it.
Illinois?
No, Illinois.
Missouri.
Can I call it cancer?
You can call it misery if you want.
Oh, God.
But the bottom line at the end of the day here is that you've got great plans, and
you have great plan options,
and being able to also understand where your maximum exposures are, which we can help you do because we can say, hey, you're taking these medications, we're running them through the computer, and by the way, this is how much your out of pocket is for those, and this is what your maximum could be for, under your Medicare Advantage plan or your supplement. Really can help you in terms of peace of mind when it comes to creating your long-term financial plan.
Absolutely. We have a couple of great text questions we should grab before we get to the break, I think.
That sounds good, so let's do that.
Do you anticipate with the recent legislative enhancements that prescription drug plan premiums will be reduced, or will this impact co-pays, etc.? I currently have Original Medicare and a supplement and a prescription drug plan. So, unfortunately, there's a little hook to all the excitement about the enhancements to the Medicare prescription drug plans, which are that they're not going into effect for 3 to 5 years. So, if you remember, just like the Affordable Care Act, when that legislation was passed, it took several years to fully implement the program. Or, if you remember, when the Affordable Health Care was passed and they said that this would close the donut hole for Medicare Advantage plans, there was some cost shifting involved in the creation of the Affordable Care Act, which tied into Medicare funding. It took 5 years to get to the place where the donut hole was closing as much as it will. So most people know, if you're using Medicare right now, that you still have a donut hole to contend with or a gap in coverage that they often talk about. So I do not think that you will see, well, I know for a fact that you won't see any major changes to your Medicare, to your prescription drug coverage based on the legislation for this year, because Medicare requires approval of all plans by March. So all the plans for 2024 had already been approved before the legislation even passed.
I mean, I was going to say, I would say intuitively, being in the healthcare market for over 30 years, your premiums probably aren't going to go down. What they'll probably first try to do is hold your copays at the current levels. But then what will happen, because from what you've explained to me, is that if the retail price of these drugs are going down, that means it'll take longer to get through the donut hole.
Right. So it's also a little sleight of hand.
That's probably ultimately what's going to happen. So if you don't take a lot of drugs,
it's not going to have a huge
SOL.
impact.
But if you are taking a lot of drugs like grandma's, then you may get through the donut hole a little bit slower, and that's not a bad deal.
Absolutely. We have 2 more, and I think we'll grab them after our second break of the hour.
Don't touch that dial. It's 8:45 here on the Big 550 KTRS. Aaron and I, Rob, will be right back.
This is Straight Talk on Retirement on the Big 550 KTRS. Here are Jeff and Aaron Lapidus.
That's right. We're back here in Big 550 KTRS. The last.
Woohoo! No?
Well, need to work on that.
What? I thought it was.
Woohoo!
Okay, fine.
Thank you. A little more enthusiasm. We have approximately 11 minutes left for the show. So you know what that means?
Let's have the text keep coming.
84126 on the text line or 931-5877.
I'm going to wrap up the health insurance questions and then move on. We have a couple of financial ones.
Fabulouski.
My daughter's COBRA runs out a year before she's eligible for Medicare. What can she do to make sure she has health care coverage for that time period? So I just mentioned the Affordable Care Act, which is a great resource for individuals that don't have access to other coverage, either through an employer, through Medicare, through a spouse. So what I would recommend is
guarantee issue. It's all
it's
good.
Guarantee issue within 60 days of having lost prior coverage. So what I would do is log on to the Affordable Care Act website, healthcare.gov, and take a look at what options are available. The site's really been enhanced over time. One, because far less people are using it at the exact same moment, but two, they've had several years since 2016 to really improve the site. You can input doctors, you can input prescriptions, and then they'll give you a full listing of all of the options available to you. Most people are still under the impression that this is government coverage. It is not. Every single insurer that you will see on the Affordable Care Act website, healthcare.gov, is a private insurer offering you private health insurance. The only reason that I suggest using the Affordable Care Act website is because you will see only plans that have no pre-existing conditions that are considered comprehensive coverage and that you have recourse for if a claim is denied, if coverage is denied for some reason, you'll actually have some recourse there versus using other insurers that may not cover pre-existing conditions.
Good question. Thank you. Next step.
Absolutely. Next question is, I found an annuity that gives you a 20% bonus on your amount and gives you 8%. What's the catch? And
the catch is that that person was eating too many gummy bears before they called.
They didn't call. They texted, but they said there's it sounds like I think they're implying there's a 10-year surrender, but it's got to be more than that.
It's probably like 20 years. I would be interested if this texter wouldn't mind texting us back. We're not going to use.
We won't use your name or the name of the company.
I want to investigate that. I've heard of a 10% bonus, which they're really not doing anymore. And the reason that they're not is because something to remember. The bigger the bonus, the longer the surrender period. So
this person said they wanted to take it out within 10 years, and I think that, like, as to your point, probably that would that's going to be the major hook, which is these have very large surrender charges against your money that you've invested plus the bonus. You probably even lose the bonus if you surrender early, and it's going to be more than 10 years.
Yeah. And, what I would suggest to you is maybe you think about how much of this money that you have can you really afford to not touch for 10 years? And how much of this money you're thinking about investing in an annuity contract you're really going to need earlier. And maybe you put those into two separate buckets.
That's smart. You don't want to put yourself in a position where you have to pull money from a place that's going to cost you more than taxes.
Yeah, I mean, the contract probably has what we call a free withdrawal corridor. Typically, it's usually 10%. Some of the annuity companies make it 5%, but generally it's mostly 10%. So you'll have some liquidity after the first year. Do you want to wait? I mean, do you want to have to wait? Do you want to have to pull 10% per year and then theoretically take 10 years to extract all your money out?
Also, some of these contracts can have more than a 10-year surrender, like 15, right?
Exactly. I've seen them. And then what they really do is they can also, with a bonus like that, they're really going to stack a surrender charge in the front. It's like, oh, you gave me 20%, I can walk away with that.
So it's probably like a 20+% surrender charge.
Which is, I can't even believe they get that past the insurance commissioners, but they can't get it past us.
Not ideal. necessarily.
Exactly.
And also, I think to your point, Dad, nothing is a good deal, so it makes sense to make sure that the product you're selecting has a function in your portfolio.
Yes. What is the purpose of it? There is no good deals.
Right. So I did get another healthcare question.
Fabo.
Aaron, please explain the donut hole on prescriptions. They're really trying to put me on the spot today, huh?
I'll give you 2 minutes.
2 minutes. All right. So basically, the way the donut hole works is during the Bush administration, they added prescription drug coverage to Medicare, and in true government fashion, they didn't integrate it into Medicare. They just threw it on top of what already existed.
So it only applies to prescription drug charges.
It only applies to prescription drug charges, and the gap or the donut hole is not no coverage, it's reduced coverage. So if we think back to prior to the Bush administration, there was very little to no prescription drug coverage for Medicare enrollees. So this is a big enhancement. I would think about it like that. What happens is there are multiple phases or tiers of your coverage. So most people recognize tiers as tier 1, tier 2, tier 3 in terms of what type of prescription they're taking. Is it a preferred generic, non-preferred generic, preferred brand, non-preferred brand? Medicare tiers in a second way based on expenses. So you start out in the deductible phase of the coverage. It's $325 is your deductible. Many insurance companies will waive that deductible, so you get right into the copay phase. So from $0 to $325 is deductible. If that's waived, it's $0 all the way up until it's a little over $7,000. $7,000. You get to pay copays. Now, it's not the value of your copays that's being recorded. It is the price of the retail drug that is being recorded every time you fill it. Once you hit that maximum on your copays, you go into what's called the donut hole, or it's referred to as the gap. Unlike copays, you will flip to what's called co-insurance. Co-insurance is a percentage versus a specific dollar amount. You pay about 58% of the generics value, and you pay 63, I think, percent of the brand name value of the prescription. So you can see how this might become very pricey for people if they are taking more expensive brand name drugs. Up to the max is $7,555 last year. It manipulates every year based on CPI, also based on the Affordable Care Act, where it was closing the donut hole. It was bringing the deductible up and bringing that max of the donut hole down. That's since ended, so the donut hole is what it is theoretically moving forward unless other changes are made. Once you exceed the gap in coverage, you reach what's called catastrophic coverage, where you have a significant reduction in the expense of your prescriptions. It's between $1 and $9 copays thereafter, depending upon what prescription you are taking. So there are some companies that will provide some protection in the donut hole. For example, if you're taking 3 meds, Cymbalta, which is a brand name, and 2 generics, all 3 of the medication cost will increase in the donut hole, even though Cymbalta is the only one that really drove you into the donut hole. Some insurance companies will continue to maintain your other prescriptions at lower prices. So like your generics, if they were $0 before, they may still be $0 in the donut hole for you. And that's really the extent of the additional coverage that's been offered by insurance companies as of this year. Last year, United Healthcare offered a pilot program to offer insulin to diabetics at a $35 copay throughout the year. I've heard that part of the government legislation that was just passed is to help reduce the price of insulin. So I'm sure that United program played into some of that, but I cannot reveal what the 2024 plans look like quite yet, so I can't say if there have been any additional enhancements to protection.
Big question, good answer. We have about 2 minutes left in the show. So what I would like to remind everybody is that if you are over the age of 55, within 5 years of retirement, wanting to retire, wanting to figure out if you can retire and when you can retire, do I have enough money if I retire so that I can retire? All of those options. It's easy to do. The way you get those questions answered is by having a coaching session. And if you'd like to have a coaching session with Aaron and I, it's easy to do. You can do it one of a couple ways. Number one is you can give our office a call, 314-863-0008. Again, 314-863-0008. You'll get a recorder today, but we'll be happy to call you back. Our assistant, Kelly, will call and arrange a convenient time for you to come into our offices and all of that. Unless you live too far. Don't feel good.
We can do Zoom or phone.
We can do Zoom by phone, and what we usually do is we'll ask you to send us some financial information before then so that we can be in a position to be able to review that information and have a meaningful discussion with you. If you are going to come to our beautifully new redesigned offices in Clayton, easy to do. You can either give us a call or go to our website, jblfinancial.com, click on the Contact Us section, and again, Kelly will call you. She'll send you a map, and we'll invite you for the best coffee in town and
Easy
a bunch of smiles.
That's right.
And thanks so much for tuning into the show today.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Be listening next week at 9 for more straight talk on retirement with coaches Jeff and Aaron Lapidus on the Big 550 KTRS.